Dzień dobry. Chciałem przywitać się z Państwem z hotelu Warto w Warszawie, gdzie odbywa się konferencja organizowana przez Fidelity International. Tematem przewodnim dzisiejszego wydarzenia jest odporność globalnych marek napędzana trendami geograficznymi. Zaś jednym z prelegentów podczas dzisiejszej konferencji jest pan Carsten Roemheld i będę miał dzisiaj przyjemność przeprowadzić rozmowę ze nami gościem. Chcielibyśmy poruszyć przede wszystkim tematy, które nurtują obecnie inwestorów na całym świecie. Zanim jednak przejdziemy do listy pytań i odpowiedzi ze strony naszego eksperta, chciałem powiedzieć dwa słowa o tym, kim nasz ekspert jest. Otóż pan Carsten Roemheld zdobywał swoje doświadczenie zawodowe w kilku globalnych markach. Swoją drogę zawodową rozpoczynał w spółce Cominvest, później pracował dla Credit Suisse, a obecnie w Fidelity International piastuje stanowisko stratega do spraw rynków kapitałowych. I chyba jest to już czas na sesję pytań. Good afternoon. I'm really glad that I have a chance to talk with you, and I hope that our audience will find this conversation interesting and investors will familiarize themselves with the strategic point of view of Fidelity International. And I think that the beginning of our conversation starts in a pretty good and optimistic mood, because we are in the course of long-running bull market in the US stock market. But the crucial question is, how long can it go?
It's a very tough question and a very good question, because for the last 15 years or so, the US has been the dominating stock market overall. It has really taken up a lot of market share, and it's been true to a superior profit performance. You have to say it doesn't come out of thin air. It comes because the profit growth in the US has been superior, and it's been due to a high level of good growing companies like technology companies, mega cap companies, but it's also been due to a very good capital management in terms of stock buybacks, and the reinvestment rate in the US is very high. So they've managed to really be on a superior level. I think there is a limit to that. And I think when you look at the global market share with almost 70% in some global indices, the US is overextended in some ways. And there is time for a reversal somehow. So I think that if you look at the profit growth over the next few years, probably there will be some other regions that can maybe catch up a little bit and take some market share away from the US. So I'm not sure if the US dominance will really persist for the next 5 to 10 years or so.
And what are Fidelity's probabilities for commonly discussed scenarios for growth in the US, like meaning hard landing, soft landing, and no landing at all? And the question is, what can soft landing scenario mean for investors in stock market? Because it sounds quite optimistic, but is it really so optimistic from your perspective?
It sounds very good. A soft landing would be something like an ideal scenario, because in a soft landing, it means that the central banks, they are managing the interest rates. They are managing to calibrate the interest rates exactly on the point where the economy is not slowing very meaningfully or going into a recession, but they're also slowing the inflation rates so that they are not giving a problem going forward. And if you think about the complexity in financial markets, and you think about the complexity of the world that we live in right now, that even central bankers do not make longer term forecasts and they are driven by data that are coming in, then you would wonder, how can they even manage to set the interest rates on exactly that level where it's neutral, you know, for the economic development and for inflation rates. I think, if anything, a soft landing can only be a transitory phenomenon, and we are in a soft landing right now, but it has to go one way or another. Either we go through and have a good cycle like the no landing scenario, or we go into a recession, because every interest rate cycle has caused a recession in the past. And some indicators in the economy in the US are showing that we are going slower. The job market is slower. Some of the early indicators like ISM and PMI numbers are showing some slower developments. So I think a hard landing is not out of the blue. It's not an impossible scenario. We have a scenario for 55% soft landing, 30% hard landing, and 10% no landing, basically, right? So the market, on the other hand, thinks that a soft landing is likely with 80% likelihood, if I look at the latest data in the Global Fund Manager Survey. And only 10% think a hard landing is likely, and 10% think that no landing is likely. I think it's a spot where we can stay for a while, but I see the economic numbers deteriorating, and I'm afraid a recession is not out of the way. Next year, we might head into a recession in the US.
You've mentioned the complexity of the market environment, but could you please point out some key risk factors that may affect the probabilities you already described?
So risk factors are the economic development. So if a hard landing is happening, then the stock market will react accordingly. If we get trade tensions, that is in the air right now, because we have an election in the US where we will probably speak about at a later point, but the elections bring some uncertainties with it, because it seems like the globalization has reached its peak some while ago and it's now going down. It seems like the global trade that was once very good and lucrative, nations with the cheapest cost have produced goods and they were delivered via the logistics chain very quickly. But it seems like that the whole globalization is being set back, and that people try to get back to national value chains. That increases the cost, that increases inflation rates. That is a risk. We have the geopolitical risk. So the China-US tensions, obviously, that has to do with trade, but it has to do with technology leadership. Who is going to be the dominating factor for artificial intelligence, for example? Are we banning the technology like the US is banning chips from NVIDIA, for example, to go to China, or the big lithography machines from ASML, they won't allow that into China. So these are risk factors. And if the trade is cut off at some point, it means that companies cannot grow in the same way as they have done in the past. Some of the big companies in the US are these multinational companies that have the big revenue in other countries. If trade is limited and restricted, I think it's another factor. And then we could find ourselves in a situation where the big interest rate hikes are causing other problems, like systemic problems. For example, a banking crisis. I'm just making something up, or another black swan. Something is happening, and then this could be another point in time, which is a risk factor. But I think the market is quite relaxed because they feel central banks will save us anyway. If we have any difficult situation, the central banks come to save us. They either lower interest rates or they inject liquidity. I think that's one of the comfort factors for investors to say, well, if there are risk factors, yes, that's true, but in the end, maybe the central banks will save us, and therefore it's not so risky after all.
So should investors eventually take care more about traditional risk factors regarding the business cycle, or rather focus on the black swan phenomena?
It's hard to focus on that because you never know when it's coming and you don't know what it's coming. The black swan is defined by something that comes and nobody has really anticipated it. So I think people are a bit too optimistic in their overall view how markets are developing. And I think the central bank put or the central bank emergency help is something that is increasing this feeling. I think we have risks in different dimensions. So it's hard to say they should focus more on the business cycle risk or maybe on the black swan events. Black swan is hard, as I say, to justify or to actually define. But the business cycle is something that people have not really taken care of as much. I think that people have just discounted the factor that we don't have a recession right now. They've just said, okay, maybe this time around the usual reaction functions are not happening. And the reasons are we got a lot of stimulation in the economies. We've got a lot of, as COVID happened, companies have thrown a lot of money into economies to compensate. And this helped people to get through the difficult phase of interest rate increases. On the other hand, some people are not really feeling those interest rate increases hard enough. Companies, for example, the big companies, they could put their cash, and they've got huge balances in parts like the Apples, the Microsofts, the Amazons of this world. They put their cash onto the money market and they get 5.3% interest. So it's crazy that higher rates are not breaking the economy down as it used to be. So in some instances, they even get some positive effect on the interest rates in that regard. But for the smaller companies, the effect is there, but it's just being overshadowed by the big companies who take the dominance in those indices, and they are being looked at. But for the consumer, for example, I think it's getting tougher as well. I mean, in the US, people are financing their mortgages for 30 years. So if the interest rate cycle within 1 or 2 years rises from 3% to 7 or 8%, they don't really feel it until they refinance at some point down the road. So this interest rate effect is only slowly trickling through the economy. But I think, again, some investors still think we get back to this low interest rate scenario that we had before COVID. And I don't think that's going to happen because inflation is more sticky. There is a bigger base of inflation because of this nationalization, value chains, higher costs, lower availability of resources. All that is adding to the costs of production. And so I think going forward, we have a bigger block of inflation. And so the rates have to be higher than before. And that is a process that will only, over time, so to speak, be felt in the markets.
For many years, the share of U.S. equity markets in equity markets overall has been growing consistently. And what are the consequences of that phenomenon for investors trying to build a long-term investment portfolio that is designed, that is built to survive in different market conditions, in different market environment?
I think it's not a good situation that we're in right now because it's not a diversified portfolio. I talked about the market share of US stocks in the Old Country World Index. In the MSCI, it's 65%. In the MSCI World Index, it's over 70%. A classic diversified investor or a diversified portfolio would be much more balanced than that because it gives you a lot of America and a little bit of anything else. And that is not a well-diversified portfolio. So I think on the one hand, if you look forward, you have to ask yourself, is the development going to the same direction so that you have to build your portfolio in the same way, or could it change? And I think one of the consequences is the dollar has been extremely strong because a lot of money has flown into the US. That is something that is on the verge of changing because interest rates in the US are falling going forward, as we probably will see with the Fed meetings that are coming. And then that makes the US dollar less attractive altogether. And that means you should diversify more internationally. In my view, the Asian part of global emerging markets is underappreciated in most portfolios. And that's due to China, which has been a disappointment over the last 3 to 4 years, or 5 even. And China is the biggest part of emerging markets. But let's not ignore the fact that these emerging economies are really growing a lot going forward. And they're growing more than the developed markets in the US or in Europe going forward. So I think it would only be logical to assume that a bigger part of the portfolio to take part in that growth should come from emerging markets. Now the question is, can they translate this higher growth into better returns for investors? That question still has to be answered because in China, some developments on the regulation front were a little bit counter to that. But I would diversify a broader portfolio. I think that the dollar is slowly declining. And a big price that the US has paid, by the way, is the big debt, the big deficits that the US has built. The US has thrown a lot of money at the economy after COVID. They have increased their debt by a lot. Like we've increased the debt by $3 to $4 trillion over the last 3 to 4 years. And that is something that's unsustainable over the long time, because with the higher interest rates, the interest rate repayments are a lot bigger in the budget for the US. And that is something that is hard to manage going forward. So I think the debt is another problem that the US is facing going forward. And both parties, the Democrats and Republicans, they have to think about how to get the debt, back in check. But I think they're much more worried about getting votes right now. So they're really open to increase the debt further. And that's not a good situation.
You've mentioned the need for diversification. And could you please explain to us, meaning investors in Poland, why there is so much reference to China in investment materials of Fidelity International? Can China be considered as a proxy to emerging markets overall, in total? And why, for example, India is not such a hot investment topic nowadays?
Yes, very good question. So let me get on the China topic first. I think China is a very major economic power, and it's only a question of time when China will overtake the US as the world leading economic power. So it is only natural that you look at China and you try to evaluate how important China is going to be going forward, and what kind of growth they can develop, and what kind of shareholder returns an investor can get. And because the situation has been so bad in China for investors, because the last 4 years or so, the returns have been really bad, and because their weight is so high in emerging market indices, that's why you have to even more ask yourself, at a time where this market is cheap, nobody wants to be in it. China is disappointing to many people, right? It offers a lot of option value in that regard. So this is a time when you can get some really nice, good companies. For example, let's say artificial intelligence companies, right? If you compare the US artificial intelligence companies to Chinese, the valuation differential is immense. I think the US companies get 4 times the valuation multiple or something like that. While it is justified that they grow their profits really a lot, in China, nobody wants to own them, although there are really good companies in there. So that's one example of people have completely turned away from China, although there are really good and innovative companies over there that can be bought at a cheap price. And I think you have to see that if you build a longer term portfolio, and you don't only have to look back in the back mirror and say, what has worked well, I'm buying that again. As a diversified investor, you want to buy those things that you can get more cheaply right now, but that can offer you a value going forward. And with China, it is critical, okay? I can understand why people are keeping away. There's also the political uncertainty and some questions. But if you neglect those for a minute, and if you just assume that you want to look at the economic development in China, then I think it has to take in a bigger part of the portfolio. With regards to India, it is a very important market, and we like it a lot. We don't talk about it so much. It is 10 years behind China, let's say, in the economic development. So if you look at GDP per capita or so, India is a lot further back. But of course, it has a better political system in some ways, at least a bit more like towards the Western standards in some ways. And it is an emerging economy that can still grow a lot. But investors have been really piling into India a lot, and the market has become very expensive, even more expensive than the US. And so the thing is, even we like India for a longer term perspective, we think from a tactical point of view, there could be some shifts out of India when we get a bit more volatility in markets. And that's the only reason why we don't stress India right now so much.
on stock markets, we already seen a significant shift from huge cap companies and the biggest worldwide known brands to the smaller companies with relatively cheaper valuation. Do you think that similar thing can happen in a fixed income market, and what would be the consequences for traditional 40-60% portfolio?
It's a tough question because it's reaching into a lot of different areas. But the thing with the large and small cap, there has been some changes. Yes, I think you could see some trends where the larger cap companies get a bit more money taken out of it and getting more into the mid and small caps. And I think in an environment where interest rates are falling, it makes sense because it would benefit the mid and smaller companies more than the large cap companies. The large cap companies, funnily enough, have been a safe haven in a rising rate environment. You wouldn't have thought that before. I mean, you would have thought these big growing companies that have a lot of profit in the future, and discount rates are applied to those future profits. And if the discount rates are higher, you would assume that the future profits are lower today. But funnily enough, they have a lot of cash and they've invested that, so they got a lot of positive impacts there. And I think with the changing market landscape, I agree with you that that's probably going to happen, that in this falling interest rate scenario that we get some shift in the marketplace from large caps to mid and smaller caps. In fixed income, we could see a similar thing, also shift within asset classes. I think one of the biggest shifts might happen in the money markets because we've had a huge accumulation of wealth in money market funds over the last few years. Because a few years ago, I remember 2021 or whatever, then there was 0% rates in money markets, and now we have 5% in the US in money markets. So a lot of money went into money markets, and for some people it was parked there because they didn't have any better thing to do with it. Maybe some people even had the plan to maintain this, but now when rates are falling again, I think this money has to reapply it somewhere. And for money markets, I would assume the fixed income market is the closest to it. Fixed rates, more certainty that the rates is being paid off. So the money within fixed income will be reallocated. But still, if you ask me for the 40-60 portfolio, and I would say 60% should be equities and 40% should be fixed income, I would not change this rate going forward. I would, if anything, I think for a longer term perspective, the equity market still offers very lucrative returns. And I think the 40% are now more justified with the higher rates overall, that's for sure. Because before, in the low interest rate environment, I would have said maybe 80-20 is the right allocation. But now 60-40 is back, and I think that's the easiest split you can have in your portfolio. And it also depends on your investment period, because the longer it is, the more equities I would take into it. I think for a risk-averse investor right now, 60-40 is a good allocation. I wouldn't change that. But if you are investing in periods like 10 years plus or something like that, I would even assume that 70 or 80% equities is rather appreciated because inflation will be higher going forward. I said that before. And higher inflation means that the nominal asset classes like bonds or so will have less returns going forward. So inflation is a thing that benefits equities. I think that benefits real assets like gold as well and maybe some others. But in general, I think bonds are in a higher inflation environment are not the ideal choice longer term.
And currently, there are a number of trends that are shaping the market environment. And among them is the security of supply chains at a national level, for example. And do you think that, looking forward, the allocation to particular countries will be a key factor for market returns, or would it be rather picking the super stocks and finding the best-in-class equities?
As an investor, I would always say the stock-specific characteristics are most important. Because if you look at countries or if you look at sectors, and there can be influences that are beyond one's control. For example, in the US, these top companies that we're all talking about that have like made the S&P the best investment of your lifetime in the last 15 years or so, they are all international companies and they don't generate a lot of revenue in the US. They do, but they generate a lot of revenues outside. And you cannot call them US companies. They may be founded in the US and they have their seats in the US, their firm, domestic, but their revenues are generated outside. And therefore, I think you have to look at a very specific level in stocks. Where do they generate their returns? Where do they produce? Where do they have their costs? How are the value chains impacted? So I think those things you can only assess when you're looking at the very specific stocks. You will always have those things with trade barriers or things that are maybe impacted on a country level or on a politics level. But I think those are always the second or third in line. So I would always say the stock-specific things are the most important ones to assess the earnings growth potential going forward, the business model, the input costs, and all that. I think that's most important. So if you can, you should always try to pick stocks rather than countries or sectors. But if not, then probably some other criteria are good as well. But in general, I think an investment fund is a perfect vehicle because you have portfolio managers that know what they're doing in general and that that try to get the best stocks out of it. And if you assess which fund managers do a good job, you can, I think, find a good selection of funds as well to have a global portfolio. By the way, ETFs are also possible. I don't want to dismiss that completely.
And looking ahead, what do you think? What could have worse consequences for returns on U.S. stock markets in the future? Would it be election of Donald Trump as a president, or rather the potential disappointment of Kamala Harris policies?
With the U.S. elections, it's a very hard thing to assess right now. I think the one thing that's relevant as well is not only the presidency, but also the constitution of the Congress. So it depends on if the president has a majority in Congress or not. It is always an interesting development in the US. Sometimes when the president gets elected, he gets the majority in Congress. So he has 2 years where he or she can basically rule and do the politics that they want. But then 2 years later, most of the times, when there's midterm elections, the Congress is being changed so that the American public likes the fact that they can switch the majority of Congress. So the one part of the question is it depends on the Congress and if Donald Trump or Kamala Harris is able to push through the agenda with a majority in Congress. But then the other question is, you could argue that Donald Trump is maybe worse for global trade in one aspect because he wants to set up very high tariffs, and he has said not only China, maybe 60% or even more, some Chinese goods, but he also wants to set up tariffs for Europe or other countries as well. So that could be very bad for global trade, and it could restrict companies from doing business. On the other hand, when you look at a US perspective, for US companies, some of the mid and smaller cap companies, it might be good because he is benefiting the local producing companies. He wants to get back production into the US. He wants to do tax cuts for the US companies. So it could benefit the US market as well. With Kamala Harris, it's very hard to even know what she stands for because on the one hand, she doesn't want to completely abandoned Biden's policies that he has done. But on the other hand, she has not really said, other than bits and pieces, what she stands for going forward. She talked about food prices being cut off, and she talked about some tax relief. But you don't have a good accession, I think, and a good way of knowing what her policy is going to be like. So it's a bit harder to judge. But I want to say that for the financial markets, I think those events only have a rather short-term shelf life. I know markets are looking at this in a very fascinating way, but most of the times policies have gone away and markets have moved on. And so I think the effects might be rather short on a rather short-term basis, unless, as I said, Trump is maybe going to increase the tariffs in a significant way. But if you look at historic stock market returns, you can't really say that the one party or the other has benefited the stock market more. If anything, you would have assumed Republicans are more positive for stock markets than Democrats. But if you looked at the last 50 or 60 years or so, under Democrats, the market went better. So I think you shouldn't really focus so much on the election. You should really focus on structuring a long-term portfolio and a little bit ignoring the noise that is going along with it.
Thank you very much. Mam nadzieję, że ta rozmowa spotka się z Państwa zainteresowaniem i że skorzystają Państwo z kilku podpowiedzi ze strony naszego eksperta. Dziękuję bardzo.